Welcome, curious minds, to an eye-opening journey into the labyrinth of the housing market by Morgan Housel, author, financial expert, and your guide for today's exploration. This is Smart Invest. Have you ever found yourself perplexed by the seemingly irrational behavior of the housing market? Despite economic uncertainties and common-sense indicators, prices continue to skyrocket, leaving many scratching their heads. Well, get ready, because today we're about to peel back the layers of complexity and shed light on this enigmatic phenomenon. We'll delve into the intricacies of supply and demand, dissect the role of investor behavior, and uncover the underlying forces that drive the housing market's seemingly illogical behavior. So buckle up, grab a notebook, and prepare to challenge your preconceptions as we embark on this captivating journey together. 1. Rising prices, falling logic. Despite prevailing economic uncertainties, such as fluctuating employment rates and concerns about inflation, the housing market appears to defy conventional logic. Typically, in times of economic instability, demand for housing would decrease, leading to a corresponding drop in prices. However, what we're observing now is a disconnect between economic indicators and housing market behavior. This disparity suggests that other factors, such as speculative investment and artificially inflated demand, are driving prices upward, regardless of economic fundamentals. 2. Speculative frenzy. The current housing market is characterized by a speculative frenzy fueled by a combination of factors. Investors, motivated by the prospect of quick profits, are driving up prices through speculative buying. Simultaneously, individual buyers are succumbing to fear of missing out, FOMO, fearing that prices will continue to rise indefinitely. This collective behavior perpetuates a cycle of inflated prices divorced from the intrinsic value of properties, resembling the dynamics of past speculative bubbles. 3. Artificial demand. While government interventions like historically low interest rates and stimulus measures were initially intended to bolster economic activity, they've inadvertently inflated housing demand. These artificial stimuli distort the market by encouraging individuals to buy homes they might not otherwise afford, leading to inflated prices and a speculative bubble. Consequently, the current surge in demand lacks a solid foundation in genuine economic growth, making it unsustainable in the long run. 4. Supply shortage or illusion. Claims of a housing supply shortage deserve closer scrutiny. While pundits often cite a lack of available homes as a driving factor behind rising prices, the reality is more nuanced. Many existing properties remain underutilized or vacant, suggesting that the issue lies not in absolute scarcity, but rather in a misallocation of housing resources. Additionally, restrictive zoning laws and regulatory barriers inhibit the development of new housing stock, exacerbating the perceived shortage. 5. Financial burdens. Purchasing a home in an overheated market can impose significant financial burdens on buyers. High housing prices necessitate larger mortgages, resulting in increased debt burdens and financial strain. Moreover, in markets characterized by rapid price appreciation, buyers may feel pressured to stretch their budgets to secure a home, leaving them vulnerable to financial instability in the event of job loss, unexpected expenses, or interest rate hikes. 6. Historical parallels. History offers valuable lessons about the cyclical nature of speculative bubbles in the housing market. Past booms, such as the subprime mortgage crisis of 2008, serve as stark reminders of the risks associated with unchecked market exuberance. The euphoria of rapidly rising prices often masks underlying vulnerabilities, leading to a false sense of security among investors and buyers alike. As history has shown, these bubbles inevitably burst, resulting in widespread economic repercussions. 7. The renting advantage. Renting has emerged as an attractive alternative to homeownership in today's volatile market. Unlike homeowners, renters enjoy greater flexibility to adapt to changing circumstances, such as job relocations or lifestyle shifts. Additionally, renting typically requires lower upfront costs and reduces exposure to market fluctuations, making it a prudent choice for individuals seeking stability amidst uncertainty. 8. Inflated expectations, deflated reality. The romanticized ideal of home ownership often obscures the financial realities associated with property ownership. Beyond the monthly mortgage payment, homeowners must contend with additional expenses, such as property taxes, insurance premiums, maintenance costs, and unexpected repairs. These hidden costs can erode the perceived benefits of home ownership, particularly in markets where prices have inflated beyond sustainable levels. B9. Regional disparities. Housing market dynamics vary significantly from one region to another, driven by a complex interplay of local economic factors, demographic trends, and regulatory environments. While some areas experience skyrocketing prices fueled by intense demand and limited supply, others remain stagnant or even decline in value. Understanding these regional disparities is essential for accurately assessing market conditions and making informed investment decisions. 10. Psychological traps. Cognitive biases play a significant role in driving irrational behavior in the housing market. Anchoring bias, for example, leads individuals to fixate on arbitrary reference points, such as previous home prices or asking prices of comparable properties, influencing their perceptions of value. Confirmation bias reinforces preconceived notions and beliefs, causing buyers to selectively interpret information that aligns with their desired outcome, whether it's justifying a purchase or predicting continued price appreciation. 11. Regulatory risks. Government interventions and policy changes introduce an additional layer of uncertainty into the housing market. Shifts in taxation policies, zoning regulations, or mortgage lending standards can have profound impacts on property values and market dynamics. For example, changes in tax deductions for mortgage interest or alterations to rent control laws can significantly affect the financial calculus of home ownership and rental property investment. 12. Environmental concerns. Climate change presents new challenges and risks to property ownership. Properties located in flood-prone areas, wildfire zones, or coastal regions face heightened exposure to environmental hazards, which can lead to increased insurance costs, property damage, and decreased desirability. As the frequency and severity of extreme weather events continue to rise, so too do the associated risks for property owners and investors. 30. Technological disruptions. Emerging technologies are reshaping housing preferences and consumption patterns. The proliferation of remote work arrangements, accelerated by advancements in communication technology, has altered traditional notions of location and commuting patterns. Additionally, virtual reality, VR, and augmented reality, AR, technologies are revolutionizing the way prospective buyers visualize and experience properties, potentially impacting demand for physical real estate. 14. Demographic shifts. Changing demographic trends, including shifts in household composition, age demographics, and cultural preferences, influence housing demand dynamics. The rise of single-person households, multi-generational living arrangements, and co-living spaces reflects evolving lifestyle preferences and economic realities. These demographic shifts have significant implications for housing market trends, driving demand for certain types of properties while reshaping traditional housing norms. 15. Long-term investment strategy. Amidst market volatility and uncertainty, Adopting a long-term investment strategy provides investors with stability and resilience. By focusing on fundamental principles such as diversification, asset allocation, and risk management, investors can navigate market cycles and mitigate the impact of short-term fluctuations. Additionally, maintaining a disciplined approach to investing helps investors avoid succumbing to emotional impulses and speculative frenzies, ensuring a more sustainable path to wealth accumulation over time. And there you have it, folks. As we conclude our deep dive into the housing market, I hope you found our exploration both insightful and thought-provoking. Remember, navigating the complexities of the housing market requires more than just surface-level understanding. It demands curiosity, critical thinking, and a willingness to question the status quo. By staying informed and vigilant, you empower yourself to make sound financial decisions in an ever-changing landscape. So until next time, keep seeking knowledge, keep asking questions, and embrace the journey of discovery. This is Smart Invest. Signing off, urging you to stay curious, keep learning, and thrive in the pursuit of understanding.